Analytical. This line chart tracks investment volume in US Bitcoin ETFs over the last few months. Notice the severe drop-off right here, consecutive weeks of massive outflows, ending in this flat line. Retail investors are pulling back, adopting a highly cautious approach as broader economic uncertainty forces them to rethink holding volatile assets. With speculative demand drying up so quickly, many are questioning if the long-term viability of Bitcoin has reached a permanent dead end. If you only look at surface-level market data and daily headlines, the enthusiasm that once drove billions into the space appears to have vanished. But a different reality is visible in the actions of conservative legacy banks, institutions like JP Morgan, Citi, Wells Fargo, and Bank of America. Instead of retreating from the space, these financial titans are accelerating their investments into blockchain research and development. This chart displays the contradiction playing out in real time. Over here, retail speculation is rapidly falling, but right next to it, institutional infrastructure spending is climbing steadily. These institutions are finding a utility in the code that the average investor, focused on short-term losses, isn't looking for. This is the result of the Great Decoupling, the separation between trading a volatile digital asset and utilizing its underlying software architecture. This allows major financial institutions to be entirely bearish on Bitcoin's price movements, while remaining aggressively bullish on the utility of blockchain networks. Behind closed doors, these banks are collaborating on a shared tokenized deposit network. Legacy banks aren't interested in trading coins. They are extracting the underlying engine to upgrade their own systems. The primary purpose of a tokenized deposit network is to modernize the outdated plumbing of global financial settlement. Watch how a fragmented, multi-day settlement process shrinks into an instantaneous transaction point. Removing third-party intermediaries significantly reduces operational costs. Finally, this creates programmable money, funds that automatically transfer only when hard-coded conditions are met. This highlights the completely different timelines at play. Retail investors are navigating a short-term game of daily market volatility, while banks are executing a decade-long infrastructure rollout. Because banks are focused on building long-term systemic efficiency, the quarterly price action of consumer crypto markets is irrelevant to their strategy. Distributed ledger technology is being stripped of its rebellious origins and integrated directly into traditional institutional plumbing. What's happening on a consumer's smartphone bears almost no resemblance to what's happening in a bank's server room. On one side, the chaos of daily trading apps. On the other, the quiet, methodical work of corporate development. The most important developments in finance are currently happening behind closed doors, largely invisible to the casual market observer. When historians look back at this era, they will have to decide what actually mattered. The short-term price crashes dominating today's headlines will likely be forgotten, overshadowed by the infrastructure build happening beneath the surface. The world's biggest financial players are building a blockchain-based foundation for the global economy, and they are doing it regardless of what happens to Bitcoin.